You're the man, Chris and Tyson. What are we talking about stocks right now?
Chris was just bringing up a really, really good point on what is going to be a catalyst for the stock market. I'm going to go back. We'll have a conversation about that. And then I want to go back to one of my old, not so greats, but one of my old trustees that I still have a lot of faith in and honestly a lot of shares in. So, Chris, you were mentioning some really kind of crazy stats about what's going on this week.
Yeah, so basically it's kind of a political game of chicken between Democrats, Republicans. We have the tentative deadline today for the bipartisan infrastructure package. We have the debt ceiling deadline on Thursday, so Congress has to pass the stopgap funding by Thursday. Essentially, it's, Democrats want this, Republicans won't budge. They're not going to take concessions. It's going to be an 11th hour and 59th minute type thing. Look, somebody's going to blink. Most likely they're going to get it done. Neither side wants to be blamed for, a government shutdown. If we do it, we're looking at about 6 million jobs and 15 trillion in wealth evaporating over the course of the next, 1 to 2 months if we go onto this, temporary shutdown. So again, it just looks bad. The optics look bad. It's just, you can't really see any type of, functional, we all need to get along in Washington, D.C. It just doesn't exist anymore, which is demoralizing and frustrating. But nevertheless, this all kind of started last week, Tyson. I mean, you and I had a really interesting week in the stock market last week. Equities on demand, we had like a very awful gap on Monday. The market spent the entire week fighting back. Today, the market still is in, bullish territory and clinging. But I just did my YouTube session this morning, and I think the levels that we want to watch, I want to watch the highs of all the major indices, and I want to watch last week's low, because I feel like there's a lot of uncertainty this week. But unless we break those highs or break those lows, we might just be looking at an indecision week. The Fed was reassuring the markets that, yes, although it's inevitable, we are going to have to taper and rates might raise eventually. They still wanted to soothe the market and, pet them, comb them, or just put a blanket over them, make sure that they're all warm and fuzzy. Like, the Fed is here to the rescue, and they'll do whatever it takes to make sure that employment is solid and inflation is under control. Now, all central banks are starting to take note. So when we start going from stocks into Forex, this is starting to be the narrative. Well, like, Bank of England is starting to see a stronger pound because rates are looking to hike by February and June of next year. The RBNZ is already mentioning increasing rates. The dollar's talking about tapering and raising rates. So I just go back to stocks for a second. This week, everything seems to be on the right side, Tyson. Things are bullish right now. We're not necessarily breaking new highs. I did want to note, however, that the SPY was lower this morning. So was the Qs, but the DIA was higher. We might be going back into this, growth versus value play this week and just see how the certainty or uncertainty plays out. So Tyson, we've got a ton of income plays this week in Equities on Demand. I think I posted this in Telegram for our group this morning. What do we have here? I have, let's see, we have income plays on Fisker, MVST, Skills, Rocket. What else did you income plays on? What else? Skills, Rocket. We did SoFi. I'm trying to think what else you had for this week. Anyway, we have like 10 trades running. I also put a bunch of covered calls out for this week on CLFX, or no, those are credit spreads. I'm sorry, Alcoa, MRO, Key, Arrival, and Fisker. Tyson, I might lose some stocks this week in a good way. I might lose them at highs with covered calls and hopefully turn. I mean, I was looking at my profits. It should be like $6,000 or $7,000 on some of these stocks if they get called away this week by Friday's expiration. So fingers crossed everything goes well this week, and I've got some cash to work with. And whether we have up, down, or sideways markets, that we're going to be doing our best to buy things on sale, buy what we like, and keep making money.
Yep. And one of the plays that we have expiring this week is silver, SLV. We've got a spread in silver. I like it. It's interesting. I think there's a really interesting pairs trade, Chris, that I just thought of just now. I was thinking, so we're going to be talking a lot of sector stuff here in webinars and different things like that. And I was thinking about a sector play of where XLE, the energy sector, is trading right up into an amazing level of supply right now, like literally like right now.
Yep.
I see it struggling around this area and having a sell-off probably over the next week or two. I don't necessarily know if it's going to tank down, but I see it struggling at this area, selling off. And then I was like, okay, well, the XLE is at supply. The XLV, the healthcare sector, is at demand. So you could do a pairs trade by selling the XLE and buying the XLV and look for kind of a trade, call it the come home trade, right?
Yeah.
So you got two really high quality sectors that mean a lot to the economy. They're going to kind of come in balance. V rallies, XLE sells off. However, I like this one better though, Chris. What about, because I think there's less risk in this, what about selling the XLE, the commodity-driven sector, and buying more of the SLV? I love where the SLV, I love where silver's sitting, and it's a commodity, it's an inflationary play, but I think oil's overdone to the upside. So we look for a little bit of a sell-off in oil, a little bit of rally in silver. You still have that inflationary play, but you could potentially in that trade make money both ways. Or if I'm wrong in one, I make money in the other. If I'm wrong in the other one, I make money in the. So it's a way to hedge the risk, and I think it's a pretty high probability trade. So I like both of those. I like buying silver, selling the XLE, or buying the XLV and selling the XLE. I think the better of the trades, technically speaking, probably for the next, I'd say 1 to 2 weeks, would be sell the XLE, buy the SLV. What do you think of that, Chris?
I like that a lot. I know that, I've had some interest for a while on SLV to get basically anything below like $20 for SLV. Yes. I love that price. And so we have a trade that expires this week, the 1st, so Friday's expiration, that gets us, if we get assigned, we actually own it below $20. We have another one that we're sitting on the same thing. We own it like $18 and change. So I think we went out to like November 19th on that one, didn't we, Tyson?
We did,
yeah, okay. So SLV looks great, and we're looking at kind of conservative upside of 25%, really solid upside potential around 45%. So I am not going to complain about any profits on SLV. As far as the sector plays, I love it. We have so many good ways to see that sectors are outperforming others. Some are going much faster, much more bullish. Others are selling off, and that's one thing that comes into play is traders and investors are wanting to know how to be diversified. Look at your sectors, right? We've had, for the most part, overall, the markets are bullish. Path of least resistance continues to be bullish. Sectors, for the most part, are, post-COVID performing very well. But we are starting to see that the cream is rising to the crop, and those that have been overbought and overextended are starting to come back. So just like Tyson said, if you look at those pairs, if you look at XLV, if you look at that is XLV is healthcare.
Yep.
XLV is healthcare. That has had a nice slide to the downside. I would actually, so Tyson, right now, looking at XLV, it's trading around 120, 129.90. Let's just say 130. If there's a way that I could get some ownership around like 127 or lower, I really like XLV off those levels. So I would like to see maybe a little bit more sliding on XLV before we really start to take that pairs trade, like you said. But it's an awesome setup to exploit that strength versus weakness.
Yeah, and I think kind of seeing, I'm not sure if we're going to get down to the 120, 125, but I see there's kind of a reverse gap fill down towards that 127.50 level that we put in. I think that could be in the cards. I like that play though, because there's also, one thing that we're going to be talking a lot about in the upcoming webinars, and we're actually going to be putting on a class, is kind of the idea of sector rotation. And people need to understand that in certain economic cycles, when you're early on in cycles, there's sectors. Just give you guys a little bit of a hint. In an early expansionary environment in a cycle, you want to be in energies, industrials, materials, consumer discretionaries, because that's when money is typically getting cheaper and creating kind of a floor. That's when we see expansions and infrastructure, people traveling more. They're coming out of a bad time, going into a good time. But then once you start to get out of that, you want to start to go into, like right now, I think hiding out in financials is a really good thing. Real estate was good for the last year. I would start to get out of real estate, not don't sell your home, but get out of some of the home builders, because what happens is when we start to have worries about raising interest rates, we have this flood of people buying and refinancing and stuff, and that helps real estate stocks because they want to get in before the rates go up. But then once the rates go up, so you want to go, let's just say early on in an expansionary cycle, you go discretionary stocks. People are going to buy their Nikes. They're going to go to their movies. They're going to do that kind of stuff early. Then a couple years into that, you want to go into the financial stocks once we create a floor in the interest rates, the real estate stocks, once we create a floor, because then people will start to buy up real estate looking to get that cheapest money. When we start to get signs or rumors of raising interest rates, you dump out of real estate, you go into financials, because financial spreads and margins actually start to go up. So, Chris, there's ways, and right now we are I think we're getting later in the game, which is kind of weird because we haven't even raised interest rates yet.
Right.
But I think the financials are starting to get to a point they're already pricing in the margins and the earnings they're going to earn when the interest rates are when they raised the interest rates.
Yep.
So I actually want to start looking for late economic expansion type of sectors to go into, such as like staples. These are the boring ones, right, guys? Like Procter and Gamble's, which toothpaste makers and toilet paper, utilities and healthcare. So I actually think, I'm not saying right now, but I think over the course of the next, I'd say 2-3 months into next year, looking at consumer staples, utilities, or healthcare is going to be the way to go. I
agree. And Tyson, actually, while you're talking about that, I just looked at the 10-year note and noticed that, we're at 1.48. I noticed the mortgage, the average 30 years now 3.13. I was actually reading over this weekend that probably by this time next year, we're talking about the average mortgage probably at 3.5 to 4%, as opposed to where it was literally a month or two ago, which was sub 3. So, is real estate gonna overheat and crash? Probably not, because demand is still crazy high and inventory is still super low and rates are still actually low. We're just in a phenomenal time right now. Like, if you are selling your home, you're selling at the high and demand is obscene and people are paying just, sight unseen, over asking prices, and it's incredible to be a seller. But you also have to turn around and be a buyer in the same environment, which is a crazy high real estate market, and prices a little bit overinflated. Yeah.
If we want to know when the real estate market's going to be overheated, and I mentioned this a few months ago, I think it's not yet. Here's what happened. We're actually sitting at a more affordability rate, a better affordability rate today in real estate, even though houses are so high than we were in 2007, because of the low combination of higher incomes and lower interest rate.
Right.
So here's the deal. If incomes maintain the same levels and interest rates even go up to 4%, we're still not overdone.
Still okay.
If we get above 4% and income stays stagnant, that's when to be concerned. But right now, Chris, I'll give you an example. In 2007, the average debt or the average annual mortgage outlay compared to annual income was like 36%. We're at like 32% right now. So we're still not overdone on the upside. And if we can maintain that 3.5-4% rate, and we can have incomes kind of stay still or even go up. And I think incomes are going to go up. More companies are starting to pay more. Right. So I don't necessarily think that we're going to see continued booms in the real estate business, but I think we're going to start to see some stagnation and start to see a normal appreciation rate in the real estate market is about 3.5-4%. That's good.
Right.
You can't look for these 20%, booms. It's not sustainable. My house appreciated, I think it was like 36% in like 10 months. It's like, are you kidding me? That's just nuts.
Yeah.
But if I can get 3% with some of the tax benefits, I'm happy with that. I think that's where we're going to be. And then, I don't know, maybe we'll see another huge leg up and that will cause a euphoric bubble. I don't know. I don't think it'll happen in the real estate market. So I'm fine with being in real estate, but I want to look for a little bit of, so you mentioned we have to have a bullish bias. How do we stay bullish but cautionary?
Right.
Go into consumer staples, utilities, and healthcare. And it kind of leads me back to that. Let's buy the XLV. Let's sell the XLE. Let's do that Paris trade. So I really like that
a lot. Yep. Gary, would you like to chime in?
Yeah, man. I tell you, I listen. Hey, you guys are having great conversation. I don't want to interrupt, but it's definitely good conversation. The question I have for you, though, Chris and Tyson, is when you guys talk about these different levels, I know you guys are looking at technicals when you make these decisions, right? So, like for instance, XLV. If we go into XLV, Tyson, you mentioned something that the price wouldn't get down to 120. Is that what you said? Don't expect price getting down to about
120. It very well could, right? Because again, a low tide sinks all ships. If things go haywire in the market, this could continue to get beat up. I do think, though, if the market does get beat up, I think what's going to happen is this: money's going to come out of the winners, and it's going to look for high quality losers, right? So what stocks are still high quality?
Growth to value.
Exactly.
Value to growth. It's there. Yep. You're going to see that switch. We've been talking about that all year. That dichotomy is so important. That correlation is crazy right now, where it's like tech money is probably going to have to go somewhere else. Crypto money is going to have to go somewhere else. Like, there's a lot of cash out there that wants to go in the markets, but people aren't stupid. Investors aren't stupid. Hedge funds aren't stupid. That type of cash is going to go into something that still offers upside and value, not that it's crazy overextended. So I think tech money ends up going into value, and just like Tyson said, like, staples, utilities, the boring stuff is where that value really gets a lot of growth. And that's why, Tyson, we've been talking about a lot of infrastructure plays. I'm in a lot of steel right now with Alcoa. That's aluminum, and CLF and X. MRO is a couple. FCX is another one. There's a bunch of stocks we've been looking at for those energy plays and infrastructure plays.
Yeah, and typically the XLV. So the XLV is a little awkward right now because I think it does have a little bit more. It's a little overdone, a little overcooked on the upside because of COVID.
I was going to say
It's
because of
typically
COVID.
it got bid high, right? It got bid really high with these drug makers and these vaccine makers and stuff. But it's typically a safe haven stock. I think it will fall back into that. And it's a bottom line is if the economy does go through a slowdown or goes through a little bit of a sell-off, XLV, XLU, and XLY will be places that you guys can go and look for some safety in. Those are the consumer staples, the healthcare, and the utility sector. So.
Yep.
But yes, we want to tie this back to technicals also. But Gary, in the stock market, it's a little bit different. Technicals matter a lot, but what really matters is being long in the right stocks at the right time.
Yep.
And being long is very, very important. So the sectors that we're talking about are not going to zero.
Right.
Not going to happen. Could they go down a lot? Yes, but it's about relative performance. The market goes down. How do I lose less? And the market goes up. How do I make more? So how do I risk less to make more?
Yeah. Yeah, right. So how do you determine which sector to go into? Is it a technical decision, or is it just based on new fundamentals that you're accumulating, and then make a decision saying, hey, the sector looks like it's good right now based on what's happening right now in the economy, in the world, whatever? Is that what you look at, or do you go back to?
Chris and I developed what's called a sector sniper, and we developed a scoring process. And honestly, I would love to act like I'm a genius and I found these, but the sector sniper scoring process told me that the XLE is overdone and the consumer staples and the healthcare are ready for a rally. So from my perspective, I would love to say I'm a genius and I found these, but there's a process, a technical process, and a strategy that we've developed to help us with this stuff.
Thanks, guys, for joining us and listening to the session today. We're going to be back again same time next week. Make sure you guys go ahead and subscribe to the channel, smash the like button, and we'll see everyone back again next week, same time, same place. This is the team saying cheerio.